Hi folks, Scott here, and this is the wrap for Tuesday, July 16th. So this is the past 2 days worth of 5-minute candlesticks on the ES. It's S&P E-mini 500 futures. And if you may remember, yesterday was an unfilled up gap on Monday. And you see the space, the lowest point was above the blue line, so it did not fill its gap. Today we gapped up just a little bit, exactly 1 point, filled the gap, and then some. But more importantly, not only did we fill today's gap, we filled yesterday's gap. This point right there, getting a prices to retrace from today's open all the way back down to the prior's. Gosh, I'm trying to find the pointer on this dumb thing. I never use a pointer. Trying to so I can point it out, but right here, getting price to retrace all the way back to the close of its prior day, thereby filling yesterday's gap, is rare. It only happens about 25% of the time. So when it does, it sometimes pays heed to take note. So what I want to show you the results for is fading gaps after filling a prior session's unfilled up gap. So fading gaps, this will be over here tomorrow, after the prior session filled its prior session's unfilled up gap. Only happens 25% of the time. And specifically, I'm going to look at just above a 200-day moving average because it may give us a little bit more insight than just looking at all scenarios. And there you go. It's only happened 60 times in the past 11 years. So a couple things stand out. One, a gap down is less likely. It's happened only half as much historically. And if it does, it's a better setup historically when above the 200-day moving average. 75% of those have filled by the end of the day or the end of that session using an end-of-day stop and set a nice average size win. So it could be volatile. You might want to keep that in mind. Now, this doesn't show you what happens if you use our MTG stop parameters or volatility adjusted stop. Sometimes an intraday stop can reduce your win rate. So I'll have to confirm that in the morning for our members. But a gap down is clearly the better setup because a gap up is barely more than 50% chance of filling, which is unusual following a down day, you would think, right? But not necessarily so. So be a little bit more careful on an up gap, maybe more aggressive with a down gap. All right, going into today, let me show you the setups. There were gaps up across the board. And you can see, in fact, you knew this last night if you're a member of ours, that shorting a gap up historically has been a good setup, whether we gapped above the prior day's highs or between the high and the close. And that was for any of the market, or at least the 4 core U.S. indices that we follow, the S&P, Dow, Russell, and NASDAQ, both futures and ETFs. So this averages our 8 individual gap guys. First thing I always look at. And should a good setup a gap down? Wasn't necessarily bad, but we end up gapping up. 16th of the month is historically a little bit risky, a little bit small sample size there, but I've shown it with any market condition. The 16th of the month just tends to be a problematic day for shorting up gaps. I think it has to do with inflows and to funds that may buy mid-month in addition to the beginning of the month. Now, unique patterns, we have the big positive of an fading gaps after an unfilled up gap. Nice sample size during bullish markets, strong numbers historically. So here's what I posted this morning, right at 9:20 sharp, per last night's video tip. Tuesday of options expiration week during bullish markets, very positive historically. Down gaps less so. So overall, the guides were attractive. The unique data was mostly positive, and the key issue was mixed, possibly mixed opening directions and small gap size. Plus, the 16th is notoriously poor. So my plan was I'll only fade the gap with a half-size position if all 4 futures are gapping in the same direction and the ES opens greater than 1678.50. See that? I will hold some of the position for the extended target, but not risk a significant reversal. Meaning, I call that riding the position, not leaving my stop in place, but instead tightening my stop, trailing a stop basically loosely. So that was my plan, and it was an excellent plan. It just didn't make me any money today. And what I mean by that is the markets opened, or at least the ES opened, 1 tick too small. It opened at 1678.50 precisely. It had to open above 1678.50. That's what I said in my pre-market comments. Now, I had a couple people question me, well, why didn't you just go ahead and trade it? well, I mean, you got to draw a line somewhere, and there wasn't a whole lot of time to react, and it's just not my style. Now, you can set up a limit order and see if you get filled. Um, in fact, I know some of our members that do that. That's just not my style. I'm a creature of habit, and it did not meet my criteria, even though it was a pretty darn good setup, and it not only filled the gap, but hit the extended target. So that was about a 3-point win with basically no heat. So congrats to those of you who took it and caught it. The low fades was the favorite trade for the 15-minute range. That's these purple lines here, 15-minute range. That worked beautifully. Correction. I know some people in the room took it, and they must have taken profits early or proximity rule or something, because it doesn't look like it made it. See, the high may have gone to 68 in there. You would have gone long, one tick above the 15-minute low, 1674.75. It did not take it. Wasn't quite strong enough. Came back over. The first hour guides triggered, and that was weak. Again, the data just wasn't strong enough. Plus, advanced studies on the website really weren't clearly favoring the low fade. So I left the range trades alone. That was a good thing. And markets broke down, and the ES traded below its lows all day. Nice tight range. So I did absolutely 0 trades today, and followed my plan, and I'm happy with that. So we'll see what tomorrow brings us, but that was my day, and that is the wrap for Tuesday, July 16th. Have a good one.